The S&P is down another 2% on the day, and stocks across the board have been continuing to sell off. Amazon is down 4.5% today, Google is down 5%, and every other stock I look at seems to be down similar amounts. This is causing some investors to start worrying that stocks could fall even further. But for me, I am someone who loves the lower prices, and I have been taking advantage of them. So in today's video, I want to share the stocks that I have bought this week, and why I am buying them. I also want to discuss Lululemon, as the stock is down 15% today after the company reported its earnings. Novo Nordisk is another stock that's down significantly, and I have been asked to take a look at this one as well. And lastly, we will wrap up this video by discussing a great Warren Buffett clip I came across where he discusses how investors should view price action and what they should focus on instead. So with that being said, let's get right into the video and start off with the stocks that I have been buying in the past week. Alright, so the first stock is Amazon, which is now in a 20% correction from its all-time highs. And we all know what Amazon is and what the company does. So let's discuss some of the recent highlights and why I have continued to buy more shares. In October, Amazon CEO said that generative AI is growing 3 times faster than cloud computing did. He also said that generative AI is a once-in-a-lifetime opportunity. Then further on in this article it says, AWS AI business is a multi-billion-dollar revenue run rate business that continues to grow at triple-digit year-over-year percentages and is growing more than 3 times faster at this stage of its evolution as AWS itself grew. And we feel like AWS grew pretty quickly. So Amazon's AI business is a multi-billion-dollar business that's growing triple digits, which means that it's more than doubling every year right now. In the most recent quarter, Amazon's CFO also said the majority of the spend on CapEx is going to support the growing need for technology infrastructure. This primarily relates to AWS, as we invest to support the demand for AI services, while also including technology infrastructure to support our North America and international segments. Then Amazon's CEO said, AWS has more demand that we could fulfill if we had even more capacity today. I think pretty much everyone today has less capacity than they have demand for. I actually believe that the rate of growth there has a chance to improve over time as we have bigger and bigger capacity. And this was kind of the theme in the fourth quarter across Google, Microsoft, and Amazon. All of these businesses were saying that they're capacity constrained, and if they actually had more cloud computing and technology infrastructure, then their growth rates would have accelerated and been higher than what they posted. So these companies are all seeing more demand than they have capacity for, which is also why they're investing hundreds of billions of dollars into cloud computing and capital expenditures. I also went over to Amazon's investor relations page to take a look at their AWS press releases, and every week there's multiple new companies signing on with AWS or growing their existing contracts. It's endless, and if you want to see this for yourself, then go to Amazon's press releases page, and there's dozens and dozens of new AWS news. Cloud computing and generative AI is still growing rapidly, and this business is scaling incredibly well. One of the other reasons why I continue to buy Amazon stock is because its highly profitable business segments are all continuing to compound very rapidly. Here we can see that Amazon's third-party seller services is compounding by 20% annually, its subscription services 16%, AWS is compounding at 24%, and advertising services is also compounding at 24%. And as these businesses continue to grow at a faster rate than Amazon's overall revenue, then they will continue to make up larger and larger portions of Amazon's revenue and overall business. This should ultimately cause Amazon's profit margins to continue expanding, as these businesses have higher profit margins than Amazon's overall business. And Amazon's gross margin over the past 14 years clearly demonstrates this. Back in 2011, Amazon's gross margin was sitting around 20%, and in the most recent quarter, it is now hitting a fresh all-time high of about 48%. And I do think that as Amazon's AWS, advertising, subscription services, and third-party seller services businesses continue to compound, that these margins will only continue to grow over the long term. And as a result, Amazon's profits should continue to grow at a faster rate than its revenue as its margins continue to expand. I also did a quick discounted cash flow calculation on Amazon to show you what I am expecting for this business going forward. So here I am saying that I am expecting its operating cash flows to continue growing around 12% annually. I am expecting the company to dilute by about 1% annually, and for it to trade for a price to operating cash flow multiple of 22, which is well below the company's long-term average of 25. So if Amazon can continue to grow its operating cash flows by about 12% annually and maintain a 22 priced operating cash flow, then the stock could return about 16% annually over the next 5 years, and its fair value is about $250 per share, which is about 30% above where the stock is currently trading. And I personally think that Amazon can continue to compound its cash flows by 12% annually going forward, and that is why I think that the stock is looking undervalued and could produce market-beating returns over the next 5 years. And this is ultimately why I am continuing to buy Amazon and increase my position. Now let's move on to the next stock that I have been buying over the past week, and this one is Mercado Libre with the ticker symbol MELI. Now, I recently made a full video on MELI's fourth quarter 2024 earnings results, so if you want a deeper view into the business and its financials right now, then I would recommend going and checking out that video. MELI is a stock that I have been continuing to research and build conviction on, and I have been making it a larger and larger portion of my portfolio as my conviction has continued to grow. This company is an absolute beast in South America. It's basically the Amazon of Latin America, but it also has a fintech segment of the business. Like take Amazon's business, but instead of AWS, MELI has a fintech business, and it's basically a digital online bank in Latin America. That's the real difference between MELI and Amazon. And very quickly, I want to show you how ridiculous this company's growth has been over the past about 20 years now. So we can see that its revenue has been compounding by 39% annually since 2006. And in 2024, they had another year where revenue grew 37%. This is one of the most beautiful revenue growth charts I have ever seen. MELI's gross profits are growing just as quickly and hitting fresh all-time highs. The company's GAAP earnings have also been exploding since about the third quarter of 2021, and they just hit a fresh all-time high of roughly $2 billion in 2024. But what I find very impressive about MELI is its free cash flow generation. In 2024, the company did about $7 billion in GAAP free cash flow. However, their fintech platform does receive some cash from customers up front, so I estimate that the company's true free cash flow generation is about $5 billion per year right now. And that's actually what I use in the DCF calculations that I do and when I am valuing the business. And today, we can see that MELI's market cap is $106 billion. And as I just said, the company is producing roughly $5 billion in annual profits. So the company is trading for about 21 times free cash flow on the stock market. And I think that this is a very attractive price because, as I said, MELI has been compounding its revenues by 40% annually for about 20 years now. And once again in 2024, they grew revenue by 37%. So when I take a look at MELI's business, I see that it is highly profitable, its profits are growing extremely well, it's trading for about 21 times cash flows, and its revenue is currently growing at about 37% annually. And when I put all of those together, I think that this stock is looking extremely undervalued, and that is why I have made it a larger and larger portion of my portfolio, why my convictions have grown, and why I continue to buy it in the stock market today. Recently, MELI's CFO also did an interview on Yahoo Finance, and I thought that this was a great interview. So I'm going to play the clip, and then we will discuss the highlights afterwards.
Exactly. Well, let's bring in now Martin de los Santos. He is the CFO of Mercado Libre and he joins us live from Uruguay. And Martin, thank you so much. So first of all, what are the next steps that you're going to take in order to continue with this massive growth and to surprise analysts once again?
Good morning. Thank you for having me. Pleasure being here. Yes, as you know, we operate the largest commerce and fintech platform throughout the region. As Nina mentioned, we operate in 19 different countries and we live in all of those countries. And in terms of investments, we will continue to invest in our logistic infrastructure, which is a critical competitive advantage, as well as investing in our fintech solution. As you know, Latin America is an area of large opportunities. When you look at e-commerce, penetration continues to be relatively low compared to other areas of the world with penetration of 15%. So it's like where the US was maybe 10 years ago. And in terms of fintech, it's even larger, right? When you take the example of Mexico, less than half the population in Mexico have an account, a bank account, less than 15% have a credit card. So we see a large opportunity. And we are taking advantage of that and we are leveraging on that. Last year, we had about 100 million buyers on our e-commerce platform, 61 million monthly active users of our fintech solutions, growing at 34% year on year. So we have experienced very rapid growth. We turned 25 years last year, and we went from being a startup in a garage 25 years ago to becoming the most valuable company in Latin America. But still, when we look ahead, the opportunity continues to be very, very large for us.
Yeah, Martin, you're still growing, of course, at fast rates, similar to a startup. I'm wondering, you talked to us about your investment strategy. You're facing competition from not just Chinese e-commerce chains, but also then from Walmart. So I'm wondering, sort of, how do you know whether you're investing enough in your business?
Yeah, we face a very competitive market, both on commerce and fintech, and we compete leveraging our competitive advantages, which are, as I mentioned, the logistic infrastructure as the fintech infrastructure. And we continue to invest in increasing the penetration of fulfillment. That's an area of investment. And in Mexico, for example, we are north of 70% of fulfillment penetration. That means that 70% of the products that are sold on Mercado Libre are shipped from our own warehouses. But Brazil, we're still at a little bit north of 50%. So we have plenty of more penetration to increase. So we will continue to deploy new fulfillment centers. As an example, last year, we opened 10 fulfillment centers throughout the region. And we plan to continue investing just because the user experience is much better when things are shipped from our own warehouses. We can deliver faster, we can offer more free shipping, and that results in much better conversion. And that's one of the reasons why our GMV, which is a volume transacted on Mercado Libre, has been growing very rapidly. In Q4, we grew roughly at 30% year on year, which is double the rate at which the market is growing. So we continue to gain market share.
How do you balance profits and growth? I know that you have a term for that internally that summarizes that quest that you want to do of delivering both.
This is something, Nina, that we spend a lot of time thinking about and also communicating to the market. We call it growth fit because we operate in a segment that is growing very rapidly and has very large opportunities both on commerce, on fintech, and also on advertising. So we try to balance try to strike the right balance between growth and profitability. We improved significantly our profitability over the past 5 to 6 years, and we continue to deliver very healthy margins. Having said that, the opportunities are so large that we want to make sure that we do capture those opportunities, and we do not shy away from investing behind those opportunities, even if in the short term they might put some margin pressures. So we try to communicate our long-term vision to the market, but like you said, the critical thing is to maintain this growth fit mentality that we have, which is to look for growth, for the long-term growth of the company, while at the same time making sure that we invest wisely and we maintain healthy profit margins.
All right, so here I have my notes from the interview and the key highlights that I want to discuss. So the first one is that Meli is the largest and most valuable company in the region. So Meli is quite literally the largest company in South America, and they're continuing to grow incredibly well. They're also continuing to invest in the business and its rapid expansion. So the company's profit margins are artificially low right now, which is funny because their free cash flow generation is incredible. But right now the company's margins are lower because they are investing so much money into continued growth. And these investments are clearly paying off. I mean, you guys saw the company's revenue chart. So as an investor, I want them to continue investing as much capital as they can into future growth, so long as it is actually growing the business. So I think that Meli is doing everything right. And as an investor, this is exactly what I want them to be doing. The CFO then said that the e-commerce penetration in South America is still low, and it's where the US was 10 years ago. So there is still a long runway for the e-commerce market in South America to continue growing, and I think that it will continue to grow for decades to come. He then said that less than half of the population in Mexico has a bank account, and Meli is one of the companies that is trying to fix this by offering digital banking to Mexico. And I believe that they are the market leader for digital banking in Mexico as well. So there is still a long runway for future growth in the digital banking market in Mexico. Then he also said that less than 15% of people in Mexico even have a credit card. So there is a large growth rate for even just credit in Mexico as well, as digital banking and banking overall continues to grow in that market. He then said, looking ahead, there's still a lot of opportunity for the company. Logistics and fintech infrastructure is their advantage. Gross merchandise volume grew by 30% last year versus 15% for the overall market. So Meli is continuing to take market share in e-commerce as well. One thing I also really liked in this interview is the CFO said that Melly wants to continue growing quickly, but they want to make sure that they're growing profitably. And if you have been a long-term viewer of my channel, then you know that I absolutely love this because revenue growth is not the holy grail of investing. There are countless examples of companies in the market like Snapchat where revenue has 10x'd, but the stock price is still down. And the reason is because the company has grown its revenue, but it has not grown its profitability. And what creates shareholder value, causes stocks to go up, and grows intrinsic value is the future profit potential of the business growing. It's the profits of a business that cause the stock to go up, that cause the business to be able to return more cash to shareholders, and ultimately creates shareholder value. And Melly has always wanted to focus on increasing profits with the revenue. And I have a note right here to discuss the podcast that I listened to on Melly. So over the past week, I have been listening to more podcasts and interviews of the Melly CEO and management team. And there was a podcast that the CEO went on where they were discussing when Melly was, I believe it was all the way back in the year 2000, during the tech bubble bursting. And Melly at the time was an unprofitable business that was relying on outside venture capital to actually continue growing and succeeding. And Melly was raising a lot of capital as the tech bubble was bursting. Like stocks were falling as Melly was trying to close their funding round. And he said that it was the most uncertain time in the business's history because without venture capital, the business would have gone under. And he said that Melly felt extremely vulnerable. And he, as the CEO, also felt vulnerable. And in the interview or in the podcast, he said that after that funding round was closed, he made it his mission to make sure that Melly would never rely on outside capital again. Or in other words, he wanted to make sure that Melly would become a profitable business. So what he spent the next 18 months doing after they closed their round in the year 2000, cutting out all unnecessary expenses and making sure that the business was profitable and never needed outside funding again. And from 2000 to 2006, when the company did their IPO, they didn't raise any more money. They did raise some money on their IPO because that's just kind of what you do. And they never actually used the cash that they raised from their IPO, by the way. So I actually don't know why they raised money at the IPO, but whatever. But he basically said that the company after the year 2000 and after that experience never needed outside funding again. And that's the way that they run their business. And that's the way that they always focus on growing profits with the overall revenue. And I absolutely love this because it means that this is a company and a management team that's not going to over leverage the business or get itself in a situation where it needs to dilute shareholders massively or take on a massive amount of debt to continue growing or continue just being a viable business. This is a business that is focused on profitability and growing profitability for its shareholders over the long term, while also investing back into the growth of the business. I love it. It's absolutely perfect. It's exactly what I look for in an investment. And it's why the conviction that I have in this business is continuing to grow, because I think the management team here is extremely high quality. And for those reasons, yeah, I've continued to add to my Melly position. So I think that Melly is still looking very cheap. I think that it is significantly undervalued in the stock market, and I think that it has a great management team. And for those reasons, I have continued to build my position and make it larger in my portfolio. There were a few other stocks that I bought over the past week. One of them was Brookfield Corporation, but you guys that watch my channel know that I am actively buying this stock all the time, so that's not news, and there's not really a lot of news coming out with that company, so I'm just going to kind of gloss over that one. But I want to let you guys know that I have bought more Brookfield over the past week as the share price has come down. I've also purchased a few smaller cap stocks, but I don't talk about these ones publicly because I just feel uncomfortable talking about smaller cap businesses on a larger YouTube channel because these stocks do not have a lot of volume. And if I direct attention to the stocks, then I may look like I'm trying to pump them up or they may see some increased volatility. That's never my goal. It's not what I try to do as an investor or as a YouTuber. So it's just the way it is. I buy some smaller cap stocks and I don't like to talk about them publicly, but I do talk about them with my Patreon community, and I do show my Patreon my full in-depth portfolio and all of the stocks that I own across all market caps. So if you are interested in getting full access to my portfolios and seeing all of the stocks that I am actively buying and selling, then consider checking out my Patreon. It's only $15 per month, and you also get a lot more content from me. You'll also get a lot of deep dive stock analysis videos on the stocks that I own that the YouTube channel just simply does not see. These videos are hours long of me going in depth and doing ridiculous amounts of research. So again, if you want to get all of that content, access to my Discord, access to my portfolios, and access to all of the stocks that I am buying, then consider checking out my Patreon. People have been absolutely loving it, and I think that you will too. But with that being said, let's move on to the next stock that I want to talk about in this video now, which is Novo Nordisk. Novo is the maker of the Ozempic drug that's taken off in the United States and around the world. The stock is now down 52% from its all-time highs though. However, its revenue and net income have been absolutely exploding. And this is causing people to ask me if I think the stock is looking cheap and if I think that it is a buy now. So let's talk about the recent news that is causing the stock to decline. And the first one here says, the core patents for Ozempic or semaglutide are set to expire in 2026, but secondary patents could extend protection until 2033, with the US patent expiring in 2032. So Ozempic's patent is set to expire next year, and I think that people are worried that Novo could start losing revenue when this patent does expire. Recently, Novo also had some disappointing results from its next obesity drug, CagriSema. The stock fell hard after these results, which caused the company to try and defend itself online. In this article, it says, headline results from Redefine 2 late-stage trial released earlier this month showed that CagriSema helped obese or overweight adult patients with type 2 diabetes lose 15.7% of their weight over 68 weeks. A prior late-stage trial published in December showed the drug helped obese or overweight patients with one or more comorbidities, but not type 2 diabetes, lower their weight by 22.7% after 68 weeks. Both results wiped significant value from Novo's share price, as investors hoped of finding a superior alternative to the company's existing Wegovy injection, and rival Eli Lilly's Zepbound with both GLP-1 medications were dashed. So basically what's going on is in Novo's most recent weight loss trial, they only saw 15.7% weight loss reduction over 68 weeks, whereas their prior results for the same drug were 22.7%. So the most recent results were actually worse than their previous results. Novo was also aiming for 25% weight loss reduction over 68 weeks, so it is missing its targets that it set out, and that is what investors were hoping for. Eli Lilly is one of Novo's largest competitors, and it has Zepbound, which is another GLP-1 medication for obesity, and this drug is actually working better than the new drug that Novo is trying to get through its clinical trials. Zepbound is said to help patients lose 21% of their body weight over 72 weeks. And again, Novo's new drug that they're trialing only lost 15% of body weight over 68 weeks in the last trial. This suggests that Novo's new drug isn't going to be better than what's already on the market and available from its competitors. And the competition in the obesity drugs market is definitely intensifying. The majority of Novo's revenue growth has also been coming from Ozempic. And as we saw, Ozempic is seeing increased competition from companies like Eli Lilly, and its patents are projected to run out. New drug trials are also not as good as investors were expecting, so if Novo cannot get a new drug that is better than Ozempic on the market quickly, then investors are worried that it could start to see its fundamentals and revenues start to decline. Now let's take a look at Novo's price to operating cash flow versus its history. And currently, the company is trading for about 18.3 times operating cash flows, and its long-term historical average is about 21.5. So the company is trading well below its historical average price to operating cash flow multiple now, which could suggest that the stock is looking cheap if the business can actually continue to grow in the future and continue to launch successful new drugs. However, I do not think that Novo stock is looking like an absolute steal right now. Like, this is not a drop-dead price where I need to go out and start buying the stock right now. And I think that the stock is down so much from its all-time highs because it did get overvalued. Here in May of 2024, the stock was trading for 42 times operating cash flows. And we can see that the multiple has now contracted, but I don't think that Novo was ever worth over 40 times operating cash flows. That's a pretty high price to pay for any stock. So I am happy to see that the multiple has contracted, but that doesn't necessarily mean that the stock is an absolute steal now. I also personally do not invest in healthcare and drug companies like this, as I believe their futures rely on continuing to launch successful drugs, which I have no idea how to predict if they will be able to do that. Novo does have a phenomenal track record of continuing to create new drugs and sell those drugs and make profits, but this is entirely out of my circle of competence, and personally, I do not feel comfortable with a business model like this. So stocks like Novo and Eli Lilly are not ones that I am personally interested in buying, But with that being said, if Novo can successfully launch new drugs and continue to grow its revenues and profits, then I do think that the stock is arguably looking undervalued today and cheap. But I don't think that it is like super cheap. I just think that it is selling below its historical average price multiples. So if it can continue to grow, then relative to its history, it is looking cheaper. All right, now let's move on to discuss Lululemon stock and why it is now down 14% after the company reported earnings. Now, first off, let's take a look at its share price because it is trading for $293 today, which means that the stock has now been flat for roughly 5 years. Obviously, it has been kind of volatile over this period, but the stock has now not produced any returns since May of 2022. If we take a look at a 1-year chart, the stock is also down roughly 30% from its recent highs, so the market seems like it is kind of bearish on this one, and definitely bearish after the company's earnings. As always, I went through Lululemon's most recent earnings report and I took screenshots from the highlights that I found. So right here we can see that fourth quarter revenue increased by 13% and full year revenue increased by 10%. So the company's revenue looks like it is still growing and it grew quite significantly in the fourth quarter. Then they say for the fourth quarter of 2024 compared to the fourth quarter of 2023, once again, revenue increased by 13%, America's net revenue increased by 7%, international net revenue increased by 38%. However, excluding net revenue from the 53rd week of 2024, revenue increased by 8%. Then they say comparable sales, which excludes net revenue from the 53rd week of 2024, increased by 3%. So in reality, on a comparable basis, Lululemon's revenue actually only increased by 3%. America's comparable sales were flat and international comparable sales increased by 20%. So Lululemon's international business is actually continuing to grow very strong, but its America's business was flat year over year. Gross profit increased by 15%, income from operations increased by 14%, and the company repurchased 900,000 shares for roughly $332 million. So it seems like Lululemon had a decent quarter with its overall revenue continuing to grow, but again, on a comparable basis, the fourth quarter revenue did only grow by 3% year over year, and its America's revenue was essentially flat. Now, this next screenshot is the full year of 2024 versus the full year of 2023, and we can see that revenue increased by 10%, America's net revenue increased by 4%, and international net revenue increased by 34%. Excluding net revenue from the 53rd week of 2024, the company's revenue increased by 8% for the year. America's sales declined by 1%, and international comparable sales increased by 22%. So on a comparable basis, Lululemon's America's revenue actually declined, and the business's revenue growth is coming from its international sales. Gross profits for the year increased by 12%, operating income increased by 7%. So the company's overall revenue did grow by 8% this year, but again, it's being entirely driven by international sales and not from its North American sales, which is where the vast majority of the business actually is. Then Lululemon gives us their balance sheet highlights, and they say that they have $2 billion of cash and cash equivalents now, and they gave us their outlook for 2025. So this says, for the first quarter of 2025, the company expects net revenue to be in the range of $2.3 billion to $2.355 billion, representing growth of 6 to 7%. For 2025, the company expects net revenue to be in the range of $11.1 billion to $11.3 billion, representing growth of 5% to 7%. So it seems like Lululemon is expecting their business to decelerate slightly in 2025, but they are still expecting the business to grow revenue by 5 to 7%, so it seems like they are still expecting growth to happen. We're also going to have to see if their America's revenues continue to decline, and if their revenue growth solely comes from their international expansion and businesses. Preferably, we would see their America's business continue to grow, but these outlooks aren't that bullish, and I think that the outlook for 2025 is why the stock is down. Now, very quickly, let's go and take a look at their income statement, and we can see that the income for the full year was $1.8 billion versus $1.5 billion last year. So net income did grow year over year, and its diluted earnings per share for the year was $14.64. Now, if we head back over to Stock Unlock really quickly, we can see that Lululemon is trading for $293. So if we input that into the calculator and we divide it by $14.64, which is the earnings per share they produced in 2024, then we get a price to earnings ratio of about 20 today. So this is what Lululemon is selling for in the market today, is a 20 PE. So let's go and take a look at Lululemon's price to earnings ratio versus its history. And once again, the company is currently trading for a price to earnings ratio of 20, and its long-term historical average has been about 42, and its median has been about 39. So Lululemon is definitely trading well below its historical average price to earnings multiple. And we can actually see that back here in 2017, the PE was about 23, and back here in 2014, the PE was 24. So this is actually the lowest price to earnings ratio that the company has been selling for in about a decade. So the market is very bearish against Lululemon right now. And if Lululemon can continue to grow its business through this weak economic time and then see further growth in the future, then the stock actually does look quite cheap today. Again, the company is trading for its lowest price to earnings ratio in over a decade. Now, personally, I do not invest in fashion brands. I recently talked about this with a Nike video. I just don't know what brands consumers are going to want to buy in 5, 10, 15, 20 years. So these businesses are extremely unpredictable to me because it seems like consumer habits and consumer trends are changing all of the time. So I don't know if consumers are going to be wanting to buy Lululemon shorts or Lululemon apparel in 5 years. And for that reason, these businesses for me are unpredictable and I cannot invest in unpredictable businesses. However, if you are someone who feels differently about the apparel industry, then Lululemon could be looking extremely interesting right now, and it could be one worth diving into further. All right, now to wrap up this video, I want to play a clip of Warren Buffett discussing how he thinks about stock prices and volatility in general, and what he believes investors should be focusing on. So I'm going to play that clip, and then we will quickly discuss it afterwards.
Stocks are down today, and I'm buying more of something I was buying yesterday. I'm buying it cheaper. Now, when you go to the grocery store and you buy something cheaper than you bought it the day before, you think that's terrific. But people with their stocks, they think that the stock knows more than they do. So that when the stock goes down, they say the stock is telling them something, And what's telling me is I can get more for my money. but they take it as kind of a referendum on themselves, and it's me versus the stock. If it ever gets back to what I paid, I'm going to sell it. The stock doesn't care what you paid. You have to remember, the stock doesn't even care that you own it. You are nothing to the stock. That stock is everything to you, And you remember you paid $10.13, and therefore the stock should get to $10.13 before you sell it. The stock has no feelings about you. I hate to disillusion you on this, but it just doesn't care. And so the only question with every stock every day, and you don't do it this frequently, is can I get more for my money someplace else? You've got a chance to be in thousands and thousands of great businesses, and their prices change all the time, so their relative valuations change. And you can make the exchange at very low cost these days. Commissions are nothing. And so you can always shift from one business to another. You have a huge advantage over Andrew Carnegie. When he was in the steel business, he was in the steel business, or Rockefeller was in the oil business. He could not shift over immediately to retailing or something like that. You can rearrange your business empire, which you own through that little portfolio that you have. You can rearrange that, at a moment's notice with practically no cost. It's a huge advantage, which people turn into a disadvantage. There is nothing about the price action of the stock that tells you whether you should keep owning it. What tells you whether you should keep owning it is what you expect the company to do in the future versus the price at which it's selling now, compared to the other opportunities of businesses that you think you know equally well, and make that same comparison. And that's all there is to owning stocks.
Man, I love Warren Buffett. This guy is an absolute legend. And here are my notes from that quick video we just played. So first off, Warren Buffett said, stocks are down today, so you get to buy them for cheaper. This is his mindset towards stock prices falling, is if they fall and the business behind the stock is still sound, then you get to buy the stock or the business for a cheaper price. And that is actually a good thing for you as the investor. Then he said, people think the stock knows more than they do. When the stock goes down, they think the stock is trying to tell them something. And this is something that I see all of the time on social media. When a stock is down, like let's say Google is down 5% today, a lot of people will look at the stock and be like, well, why is the stock down? What happened? Is there something going on with the company? Has something happened? Do I need to sell my position now? And people in general think that the stock volatility is instructing them and telling them what they should be doing with their position. So again, if a stock price is down, then they think that something is fundamentally wrong with the business and the market knows something that they don't, and therefore they should be worrying and selling their positions. Warren Buffett very clearly is saying that this is nonsense and the stock just is volatile. And you as the investor have got to have conviction in your positions and in the businesses that you own to know that stock price volatility is nothing more than stock price volatility. It is not a reflection of what is going on with the business behind the share price, and it is not an accurate instruction for you to make decisions off of. And therefore, he is also saying that he believes investors should not make their investment decisions based on short-term stock price volatility. Then he also says you as the investor should be looking at your stock price fluctuations from day to day and comparing the value of a business versus the other investments that are currently available in the market. So for example, you guys know that I like Brookfield Corporation. However, if Brookfield Corporation stock were to double tomorrow, at the same time as a stock like Melly went down 50%, then I would clearly be buying Melly over Brookfield Corporation. Even though I like both businesses and I'm actively buying both businesses, if one became much more expensive and one became much less expensive, then I would clearly be buying the one that became much less expensive. So the validity of any investment also depends on the comparable investments that are currently available to you. And this is what I do in my own portfolio as well. I look at every single stock and I try to buy the stocks that I think are looking the cheapest at the time. I'm just trying to compare every investment against every other investment that is available to me. And this is what investors should be doing. And we should also be including bonds in this process. Like if bonds were offering 14% today, then I would not be adding any stock in my portfolio at the current prices. I would be buying as much bonds as I possibly could. So you want to look at the entire universe of investments to make the best investment decision possible at all times. And that's what Buffett is trying to say here. Then he says, there's nothing about price action that tells you if you should keep owning a stock. And again, this is something that I see happen a lot in the market, where when prices fall or a stock price falls, then people think, well, this stock sucks. Why do I own it? I should sell it. And this is simply just not the way that true investors invest. What true investors do is they always look to the business behind the share price, and they don't look at what the share price is doing to make decisions. And why I think that this is important right now is because we're currently in a market where stocks are being extremely volatile and stocks are going down a lot. A lot of stocks are going down. So what we need to do in this period as investors is always stay grounded in the business behind the share price and not take instructions or make decisions on what the share prices are doing in the short term. I actually have a position right now that is a smaller one, so unfortunately I can't disclose it on my channel, but I have a smaller position right now that I'm actually down on, and I've been down on it for months now. And I'm not really selling it. I'm not caring about selling it because when I take a look at the business behind the share price, I think the business is actually doing just fine and is actually in a very good position. Therefore, I'm not selling because the price is down, because I'm looking at the business and I think the business is still sound. So moving on to the last point here, Buffett said, what tells you is what you expect the company to do in the future versus the price it's selling for now, and compare it against all other investments. So what tells you if you should continue to own a stock is the actual business behind the share price. So he looks to the business behind the share price and what he thinks that business can do in the future to make his investment decisions. He is not looking at the share price today for investment instructions. He is always looking at the business and what he thinks it will produce in the future. And that is what I try to do here on my channel as well. But with all that being said, that is going to wrap up the video for today, everyone. And if you did enjoy the video, then please remember to leave a like on it. And if you want to see more content like this, then please consider subscribing to my channel as well. And if you want to check out my portfolios, all my buys and sells, join my Discord community and get more content from me, then consider joining my Patreon. Again, people have been loving it, and it's only $15 a month, and you'll get a lot more from me. But with all that being said, that is going to wrap up the video, everyone. So thank you so much for tuning in. As always, I truly do appreciate it, and I really hope to see you all again in my next video.